Today, we're going to put on our value investor hats and do a full financial health check on a company we all know, Verizon. We're going to run this telecom giant through the gauntlet using the core principles of Warren Buffett's investing philosophy to see if it really holds up.
So what's the big question we're trying to answer here? Is Verizon the kind of steady, profitable, and fairly priced company that could actually earn a spot in a portfolio like Buffett's? Well, that's exactly what we're here to find out. And we're going to do it by letting the numbers do all the talking.
And here's our game plan. We're going to run Verizon through a 4-part checklist, all inspired by the Warren Buffett way. We'll dig into its profitability, check its debt, look at how it rewards shareholders, and finally, figure out if it's selling at a fair price.
All right, first up, test number 1, profitability. See, Buffett is always on the hunt for what he calls predictable money-making machines. He's not looking for a one-hit wonder. He wants a long, proven track record of generating really strong and, more importantly, consistent returns.
The first metric we look at is return on equity, or ROE. Let's make this super simple. For every single dollar that shareholders have invested in the company, how much profit does it kick back each year? It's a fantastic measure of how well management is actually using investors' money.
So Verizon's current ROE clocks in at 16.44%. Now, as a general rule, value investors love to see a consistent ROE in the double digits. And look at that, Verizon clears that bar pretty comfortably. That's a really strong start.
But remember, for Buffett, consistency is everything. Verizon's current number is right in line with its 3-year average of about 17%. And yeah, there's a slight downtrend if you look back 5 years. But the key here is that it has stayed remarkably strong and stable. This is definitely not a fluke.
Next up, let's look at return on invested capital, or ROIC. Now, this is a broader metric than ROE because it looks at everything, both the money from shareholders and all the debt the company has taken on. It tells us how good the company is at generating profits from all the capital it has at its disposal. And this is where we see some really positive momentum. Verizon's current ROIC of 7.57% is actually higher than both its 3- and 5-year averages. You know what that suggests? Management is getting even more efficient at turning every dollar of capital into profit. So for test 1, Verizon is looking very, very strong.
Okay, on to test 2, sensible debt. You know, even a fantastic company can get into deep trouble by borrowing too much money. Buffett looks for businesses that are built to last, with a financial structure that can survive pretty much any economic storm that comes its way.
And the classic way to check this is with the debt-to-equity ratio. It's a super simple comparison of what a company owes versus what it owns. A really high number here can be a red flag that the company is relying too heavily on borrowing.
Verizon's current ratio is 1.51. So what does that mean? It means it has about $1.50 in debt for every $1 of equity. Now, in an industry like telecom, which is crazy capital intensive, they're always investing in these huge networks, this level of debt isn't exactly shocking, but it's definitely something we need to look at closely.
But here is the all-important context, that 1.51 ratio is actually a little bit lower than its 3-year average. And that is a huge detail. It shows us that the company's debt isn't spiraling out of control. In fact, management is keeping it steady. And that's exactly the kind of financial discipline a value investor loves to see. Moving right along to test 3, shareholder rewards. For a guy like Buffett, a great business doesn't just make a ton of money, it actually shares that money with its owners. A long, consistent history of paying out dividends is one of the most powerful signs of a healthy, mature company.
21. Just let that sink in for a second. For over 2 decades, Verizon has not only paid a dividend, but it has increased that dividend every single year. That is an incredible commitment to returning cash to shareholders through recessions, market crashes, you name it.
But is that dividend actually healthy? Well, the yield is a very attractive 6.12%. Now, the payout ratio from its earnings is about 68%. But what's even more telling is the payout ratio from its free cash flow, which is lower at under 60%. This tells us the dividend is very well covered by actual real cash, and it's even safer now than it has been on average over the last few years.
And now we've arrived at our final and maybe the most important test of all, a fair price. Like Buffett always says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The goal here is to avoid overpaying, even for a fantastic business.
So let's do a simple comparison of price versus value. The stock's recent market price was sitting at $46.27.
But based on a discounted cash flow analysis, which is a really common way to figure out what a company's worth, its estimated fair value is actually over $51. That suggests the stock is trading for less than it's truly worth.
This gap between the market price and the fair value gives us what investors call a margin of safety, and in this case, it's 9.66%. Think of it like a financial cushion, right? It's a buffer that protects you if your analysis is a little off or if the company hits a bit of a rough patch. Buffett absolutely insists on this, and right now, it looks like Verizon has one. And that brings us right back to one of Buffett's most famous quotes. Our analysis suggests that with Verizon today, the value you get might just be higher than the price you have to pay for it. So we've run all 4 tests: profitability, debt, shareholder rewards, and valuation. It is time to put it all together and check out the final scorecard. So, does Verizon actually pass the Buffett test?
Here is the final breakdown. For profitability, its strong and improving returns earn it a clear pass. For debt, the level is stable and seems manageable, so we're giving that a pass, but with a little bit of caution. On shareholder rewards, well, 21 years of dividend growth is a no-brainer. That's a strong pass. And finally, for valuation, it does appear to be trading below its fair value, earning it another pass.
So, what's the big takeaway here? Well, based purely on these financial metrics, Verizon checks a whole lot of the boxes for a classic value investment. It's profitable, it's disciplined with its finances, it rewards its owners generously, and it seems to be trading at a pretty reasonable price.
But of course, this is where the number crunching ends and your own judgment has to begin. These numbers give us a fantastic snapshot of the company's past performance and its current health, but the big lingering question is always about the future. Right? How will things like competition, new technologies like 5G, and the overall economy shape Verizon's next chapter? Well, that's the part of the story the numbers just can't tell you.